Hey everyone, thank you so much for tuning in again. I'm Andy Cruz here in Business Development.
And Will Flores with Mortgage Heroes.
So we're going to talk about a couple of things today going on in the market and a new option coming up for homeowners. But before we do, you wanted to say something to everybody watching?
I wanted to, first of all, thank you guys for tuning in and watching our videos. We've been getting a lot of great feedback with all of this, Andy. And what's great about it is we're getting those questions, right? We always say it doesn't cost you a penny to get an to answer your questions, but it can cost you thousands. For not asking.
Yeah.
So, yes, I want to personally thank you guys for continuing to watch it and continuing to support us in this. So, thank you.
And a quick attachment to that, for those of you who have watched some of the previous videos where we've talked about the case for cash out refinance, we talked about the Fed's rate decision. If there's someone in your life that's kind of like saying things that might be useful for them to hear, send that to them. Send this to them because you don't know who you might be able to help with their questions that they're maybe withholding because they don't know how to ask or what to ask or navigate that. So
technology is so easy. Just hit forward, boom,
share the video.
Goes.
So first thing, before we get into the meat of today, I want to talk really quickly about the new home price index report that just came out this week. And San Diego is once again in the top 5, but something's changed. I used to say San Diego's in the top 3.
Yeah.
Because San Diego was in the number 2 spot for home price appreciation for almost 18 months. Yeah. Now we've slipped to number 4, but it's really just because Miami and Las Vegas are surging. But they're surging for, I would say, more seasonal purchasing, which is happening rather than long-term purchasing.
That's correct, Andy. Well, I was actually just there in Florida. Amazing place, by the way.
Yeah.
All these, I was in there like maybe 3 years ago. I didn't see as many sky rises. Now it's like everything skyrise, skyrise.
Yeah.
And what people don't know is that when you dig 7 feet under, you hit water.
Yeah.
But yet you see these big old buildings. It's like 30, 40 feet, like floors. I mean, they're ginormous. It's growing. It's
that water table.
There you go. There you go. But the other thing that I did hear, though, is that we're going to start seeing some price drops in those areas, and they're going to be steep, anywhere from 20 to 40%.
Yeah.
So
and I know it's going to take a little bit of time. There's going to be, just like in anything where there's a rapid rise in prices, there's going to be a correction of some sort, and there's a lot of variables that go into that. So it's not like the sky's falling tomorrow, but beware that there are going to be some changes. I mean, we're seeing it firsthand with the cost of money increasing so rapidly.
That's correct.
Just this year alone, it's putting pressure on sellers. It's putting pressure on buyers looking to get qualified. So that pressure all has to unfold and kind of roll its way out, and I think that you're going to see some more jockeying at the top, is if I'd say it that way, for the home price appreciation. But for now, San Diego holding steady, and Phoenix just keeps killing everybody. They've just been like on a
that's
rampage.
another market that's we know it grew so fast, but yet we already saw what happened in 2008-9 is one of the ones that got hit the fastest too.
And I have to add one caveat to this before we go to the next topic is because we are such a military centric town, there's a lot of staying power with home prices in San Diego, and specifically because the BAH here is adjusted to the cost of living here too. So it actually allows for there to be a lot more propensity for active duty military to be able to afford in San Diego because their housing allowance is in alignment with the costs here. And that's not the same as in Phoenix and Las Vegas and Miami and some of the others. So
and we can see more. Well, hey, we're building a lot of ships here, and you see them like once you go here to on the 5 freeway. If you just take a look at when you get that the 54 into the 5 freeway, you see them on the left hand side, and it's not just one, 2, 3, like there's a lot of ships. That tells us there's a lot of people that are going to be filling those ships. So therefore, our population in San Diego continues to grow. And therefore, the rent, that's what's driving also, hey, we need to rent somewhere.
So let's talk about that real quick. So there's some interesting stats that are coming out. So the one thing I was going to talk about today real quick regarding renting in San Diego has to do specifically with single family homes. And a new CNBC article had just come out the other day talking about how the rent for single family homes, the median rent is just skyrocketing across the country. But there's some standouts. In the top 5 most expensive median single family home price rentals, 4 of them are from California, and San Diego's number 2. Only second to LA by like $40-something.
That's correct. And the other thing, that's for single family medium, right? We also took a look at the 10 most expensive, and out of the 10 most expensive, obviously New York was up there, but
of course
we had 5
California had
have
of the
5.
top 10.
Andy, I just can't comprehend that. You know,
Yeah.
it's hard to comprehend that.
Yeah. So the translation here is, again, kind of we're talking about how San Diego has sustained value over time because of a lot of variables, but also there's the cost of renting. So at a certain point, you have to start asking yourself, like, okay, if I'm going to be dropping $4,600 a month on renting, at what point do I turn my $4,600 into owning a place?
Well, Andy, that medium was 42.
4617.
4,000. Wow.
$4,617.
Do you guys remember when we first bought your house in 2014, 13, and we were hesitant for that?
Yeah.
And the payments were like, I can't go over 2,500.
Sure.
Now we're saying I can't go over 4,000 renting.
People like choke it like
this is nuts, Andy.
Like, oh, $3,000. Like, what are you talking about?
That's just crazy.
So I mean, clearly that presents an affordability challenge for in some ways, but also if you're in a position where your credit and your income is in alignment where you can do $4,600 a month on rent, then it's worth taking a second look. Even right now in the market the way it is,
absolutely,
it's worth taking a second look at, well, how can I buy? What can I get into? Because that creates a new asset for you.
Yeah.
Obviously, we talk about tax write-offs and that kind of thing with mortgage interest and all that. But
well, I just had a client, simple story. I just had a client where they bought their home in Washington. And so their payment, they're talking about, my payment's $2,600.
Yeah.
You're coming over here, they're getting PCS orders here.
Yeah.
And their new payment is going to be $5,000.
Whoa.
Right? It'll be $5,000. So double that. And so it was encouraging to hear the wife say, hey, we've been through this. When we first got that $2,600, we were like, how are we going to do that?
Okay.
Right? Just similar to like what I did, but I stuck to the dollar menu. Thank you, Jack in the Box. No, I make no profit of that, and McDonald's dollar menu. Sometimes we have to stick with that. And then all of a sudden, the world just adjusts to where, our lifestyles are.
It kind of normalizes.
It normalizes. And next we're like, oh, I can do this.
Yeah.
And so it was encouraging for the wife to say that. I was like, hey, that's the way to look at this.
Well, I know for some people, not everything is across the board equally normalizing, but I do want you to share about what there might be some hope and some options for people who have equity in their home.
Correct.
And maybe they have they've been unable or uninterested in doing a cash out, but they might need to do a HELOC. So talk to us about the new HELOC program.
Well, one of those things, what was it? Was it last week when they finally announced that we are in a recession?
Yeah, they are. They announced, not announced, argued, didn't.
Because of GDP, right?
Yeah.
Finally, twice consecutively. So now it's announced.
Yeah.
So very important now to actually start saving, figure out a way how to pay those high credit card debts.
Yeah.
And one of the newest things is we don't want people to lose out on those 2.25% interest rates that we were providing.
Yeah.
Those
6
months ago, 6 months ago, right?
Yeah.
And so a lot of times people don't want to sell their home or they don't want to refinance because they don't want to lose that great interest.
Yeah.
And so investors understand that. Our financial institutions like us, we understand that, Andy.
Yeah.
So one of the things we're doing is let's find a better way, a better solution, and put a Band-Aid on this certain situation by consolidating the debt.
Yeah.
So now they're bringing up the HELOC, which is a home equity line of credit.
Yeah.
And actually works like a credit card, Andy. So the great thing, we're currently working with the client. They're getting $150,000. It's like a credit card.
Wow.
So they're not using, since they're not using that high credit limit, right? They don't have to pay a single payment until they start using that.
Got it. Yeah. Oh, yeah. I understand. Yeah.
You know what I mean?
Yeah.
So
there's no balance until they spend against it, and then there's a balance they pay.
Exactly. Unlike when you do a cash out refinance and you take the 150, well, in 2 months, as we know, we'll start making payments on that money. Right. And here is kind of like you save it for a rainy day. Yeah. Yes, the interest rates are not going to be as favorable, but it gives you, it's going to be a lot more favorable than that 23% interest rates on your credit cards.
Yeah. Well, I think this also goes back to what we talked about when we did the case for cash out. Something to take into consideration is it's the same in that video. We're talking about homes that have lots of equity still.
Yeah.
And the equity is untapped, unused. But people might be hesitant to come forward and say, hey, I'm kind of tight in this area of my budget. I'm struggling a little bit here. I think I want to pay some of these things down. And maybe the cash out didn't make sense on paper. For some people, it will. Maybe this will make better sense on paper.
Well, yeah. one, don't lose that interest rate on your first.
Yeah.
Get that second done. You know, kind of gives you time to see what's going to happen with the market. History always repeats itself, Andy.
Right.
So we'll see the rates go back down again.
Yeah.
At the time when they start going down, it'll make sense to probably consolidate both those loans, you know, into one. So again, that kind of fits that purpose. Allows you to keep that lower payment on that, you know, on the higher balance of it. The things that are to look at, even though it sounds easy, you still have to go through the whole qualification.
Yeah, of course.
But, you know, it's still like qualifying, like if you're doing a purchase, like when you first are purchasing, you know, you need all your documents.
Remember, you're asking someone for $50,000, $100,000, $150,000. That's not necessarily chump change.
Yeah.
Like
and
I have to think, like, if someone asked me for $150,000, like, well, what would I ask them for?
Well, and here's the thing. You can get as low as 10,000 all the way up to 500.
Oh, wow. Okay.
So, you know.
Wow, that's a lot.
Yeah, it is.
Didn't know that.
Yeah, exactly. And to a certain amount, you don't even need an appraisal.
Oh, really?
Yeah,
okay.
Go just do, you know, a desktop view of it.
Okay, so someone who's watching this, what kind of things how would they know if that's them that we're talking to or not?
As long as they're taking under $250,000 and under, there's no appraisal requirement.
Okay. And then what kind of situation would they might be facing where like, hey, I should call Will and at least ask about this?
Anytime you're looking to consolidate debt or you're looking to improve your home, do some renovations.
Okay, make upgrades you've been delaying.
Yeah, you've been upgrades, you know. Some people are going to college. I know my son's going to college right now, so it could be for many reasons, Andy.
Got it. Okay.
It doesn't have to be specific. And again, the great thing about it is you make no payments until you use that.
Yeah. Got it. Yeah.
You know, so
that's good.
That's what makes it even better.
Yeah, that's good.
A lot of times you can even, to qualify, because you have to qualify similar to a purchase or refinance. You can use that line of credit to help you qualify if needed. So instead of us handing the money, you paying it, we can do that prior to.
Oh, I see. To close off.
So there's a lot of ways to do this. Absolutely. There's a lot of options of what we can do to get this. It's a newer thing, so obviously we have to get used to it too. And as we keep moving forward, we'll just become the masters of it.
Okay, good. That sounds good.
But that's really what we had. You know, with that, here's just to provide a lot of solutions, you know. Well, it's not just it, right?
Today.
Yeah, that's it for today, you know. But we got great information. We know that rents are, you know,
super
it's
high.
crazy, you know, and so it makes perfect sense to invest in yourselves. We are in a recession, so we have a solution. If you have all that equity, which is as high as it's ever been, leverage the situation. So I think this is all great information.
Yeah, I think my takeaway as I'm sitting here listening and you're talking, I'm thinking like this is a great time for people to prepare themselves and take action, right?
That's it.
If they're looking to buy at the end of this year or looking to buy in 2023, start now. Get the process going.
That's it.
If you maybe see on the horizon that your debt may be an issue, it's not yet completely, locking you down. Okay, let's take some proactive measures now. Give ourselves some time and be proactive and maybe see what solutions are on the horizon for us.
That's it.
Okay.
Easy as that, Andy.
Great. Well, thank you guys for tuning in once again. You know, if you have any questions, please go ahead and reach out to Will directly. You can give him a phone call, shoot a text, or an email. Let us know how we can help you. Thank you for tuning in, and we'll see you again next week with a brand new topic. Keep sending your questions, and we'll answer them here on our conversations.
It doesn't cost you a penny, okay? But it can cost you thousands. I like using that because it's so true.
Yep.
You guys, thank you once again. We appreciate you from the bottom of our hearts.